They halted the market. They locked retail traders out for a full 90 minutes. And while you sat frozen on the other side of screen, watching a blinking error message, 159 million ounces of March silver contracts quietly changed hands in the shadows. That is not a glitch. That is not a coincidence. That is a fingerprint. And it is the one fingerprint they can never, ever forge. Let's talk about what just happened, because today, history is being made in real time, and most people consuming mainstream financial media have absolutely no idea what they're actually looking at. This morning, January PPI data dropped. Inflation came in at 2.9%, well above the expected 2.6%. Core PPI exploded to 3.6%, completely demolishing the consensus estimate of 3%. The moment those numbers hit screens, gold and silver went vertical. No delay. No hesitation. Instantaneous. Silver is currently trading at $92 Western spot right now. And that Wednesday high we specifically discussed on February 4th at $92 just got taken out. That was our tape reading objective for this entire week. If you've been here, if you've actually been paying attention, you already know I called $92 specifically on Wednesday before the halt. We were pushing directly toward it that same session. Then the halt hit. Price got violently slammed back down to $85. Manufactured, deliberate, controlled. But here's what they didn't count on. The market has memory, and tape readers have receipts. Yesterday, I highlighted the 150 EMA confluence on the hourly chart and the swing failure pattern that purged Tuesday's 9 a.m. New York low before reversing sharply higher. That is a bullish signature. That is what real tape reading looks like. OG speaks before it happens, not 3 days later with a recycled take dressed up as analysis. These so-called course sellers and social media gurus cannot replicate that timing. They don't have the tools. They don't have the discipline. They show up 3 days late with the exact same narrative, acting like they called it from the beginning. You either see the difference or you don't. Comment OG right now if you were here when I called $92 before that halt. That one comment tells me everything I need to know about who's actually in this room. Here's what tape reading teaches you at the deepest level. Everything connects. The manipulation shows up on charts. It shows up in data. It shows up across multiple time frames simultaneously, once you train your eyes to see it. Once you verify the homework I gave you, take any time frame, mark the significant highs and lows, and then watch. Watch how often price takes out a major low and then explosively reverses higher. Watch how often it breaks above a key high. Retail traders chase the breakout with conviction, and then it violently reverses back down. That is not opinion. That is not theory. That is tape behavior, and it has been happening since markets existed. Verify it yourself. Go back through the charts and verify it yourself. Markets are engineered to play you ruthlessly, systematically, and without mercy. So the real question becomes, are you getting played? Or are you learning to play them? That distinction right there is the exact line between dependence and independence. And independence is always the goal. Apex predator. Top of the chain. You don't need me. You don't need anyone. These tools work everywhere. Silver, equities, crypto, forex. The asset class doesn't matter. The manipulation runs far deeper than most people are willing to accept. But over time, with genuine study, the bigger picture begins to emerge. The data outside the charts starts speaking. The news starts speaking, not the way it's fed to you through a corporate filter, but the way you learn to read it for yourself. That is mastery. 8 to 12 months of genuine, focused desire, and you will surpass most of the people operating in these markets today. That is not hype. That is a documented reality. Now watch this. We've taken out that Wednesday high. Drop down to the hourly. You also want to watch for a bearish swing failure pattern forming at this level because this is also a significant high. We need to see candle bodies closing above it, not just wicks. If bodies close and hold above that high, then we can begin discussing continuation toward the next target. If not, if it's just a wick reaching up, then it's simply liquidity being taken, and we wait for the next setup with patience. The next tape reading objective sits at $94. Write that down. Now let's talk about where real price discovery is actually happening, because it is not in London and it is not in New York. Shanghai tells you the truth. Silver spot in Shanghai is currently sitting at $104. Futures at $107. Western spot at $92. That is a $12 premium, not 9 like yesterday. $12. Physical buyers in the largest precious metals consumption market on Earth are paying $12 over Western paper price, and that gap is expanding during a rally, not compressing. Check the China precious metals data from February 27th yourself. Shanghai premiums are holding firm while Western spot climbs, but Eastern physical premiums are widening simultaneously. When that divergence persists and actually accelerates through a rally, you're not watching temporary arbitrage. You are watching structural separation between paper pricing and physical reality. Whatever they are doing to manage paper price, it is not working on physical demand. The physical market is speaking a completely different language. Now let me show you exactly what happened during that Wednesday trading halt, because the mechanics here are everything. 159 million ounces of March silver contracts changed hands during a 90-minute window when retail participants were completely locked out of the exchange. During that window, while the exchange was technically dark for ordinary traders, a significant number of longs who had been planning to stand for physical delivery suddenly decided that rolling their contracts forward was an extremely attractive option. Someone got paid to go away. That is the only logical explanation for what the data shows. Here is what makes this even more revealing. Over half of those Wednesday contracts did not roll forward. They took cash settlement and left the market entirely. Normal roll behavior would see longs carry their position into the next delivery month, stay in the game, maintain exposure. That is not what happened here. Total open interest is collapsing, not rotating. These participants are not switching tables. They're leaving the casino completely. And that tells you something profound about what they think of the house and its ability to deliver on its obligations. While that paper maneuvering was playing out on Western exchanges, physical reality kept moving without interruption. Lines wrapping around the block at Bullion Star in Singapore. People standing in the rain, waiting patiently for silver and gold. Not chasing momentum. Not reacting to price action. Buying with intention and conviction. Corrections do not scare physical buyers away. They bring them in. That is a completely different mindset, and it reflects a completely different understanding of what silver actually is and what it represents. Now, add this to the picture. 11.5% of silver drained from Shanghai vaults in a single day. Nearly 40,000 kilograms left the Shanghai Futures Exchange vaults on February 27th alone. Meanwhile, COMEX data showed 1.3 million ounces drained during that same trading halt window, 218,000 from Brinks, 624,000 from HSBC, with additional withdrawals from JP Morgan and MTB. Total COMEX registered silver sits at approximately 86 million ounces against open interest exceeding 120,000 contracts. The coverage ratio is 0.60, meaning registered silver only covers 60% of a single month's delivery obligations. When vault drains are accelerating in both the East and the West simultaneously during a manipulation event rather than slowing down, the participants closest to the structure can see exactly what is happening. Now, add the India context from the last video, because this is a layer that almost nobody in Western financial media is covering. $385 billion in Indian equity fund capital has now received regulatory approval for precious metals allocation of up to 35% of positions. That is institutional capital receiving explicit regulatory permission to rotate into hard assets at significant scale. But starting April 1st, just 33 days from now, Indian regulators have directed mutual funds to value their physical precious metals holdings using domestic exchange prices instead of LBMA benchmarks. They're actively decoupling from the Western price-setting mechanism. A regulatory decision has already been made and signed. 33 days. As wealth continues moving east, price discovery will follow it. Today, history is being made. Silver is closing February in the green. That marks 10 consecutive monthly green closes. 10 months, 10 green closes in a row. The last time silver posted a sustained streak this persistent was the historic run into 1980, when silver moved from $6 to $50 in just 18 months. When momentum sustains this long, without a single red monthly close, when physical premiums widen during rallies instead of compressing, when vault coverage ratios drop to 0.60, when institutional capital receives regulatory approval to allocate at scale, when geopolitical tensions escalate toward evacuation advisories, those are not isolated variables. Those are converging structural forces building pressure in the same direction at the same time. Here is the layer most analysts are completely missing. Retail positioning in silver today is minimal, historically minimal, compared to where it stood during the 1970s bull market. ETF holdings tell you the scoreboard. Right now, if retail participants were to dump 250 million ounces through ETFs, you would see an instant structural surplus, and silver would collapse back below $50. That is how thin this market actually is when flow direction reverses. But look at what retail is actually doing. Retail is not selling. Retail is standing in the rain outside Singapore dealers. Retail held through that $4 manipulated flush on Wednesday without breaking. ETF holdings actually contracted over the past year while price climbed, meaning this entire move higher happened without meaningful retail participation at scale. The real demand surge has not started yet. When positioning shifts, when ETF holdings flip from contraction to expansion, when retail moves from net seller to net accumulator, the market structure physically cannot absorb that flow at current prices. The 1979 to 1980 example shows exactly what happens. Retail owned significantly more silver then, and when they began accumulating aggressively, silver went parabolic from single digits to $50 because the market structure simply could not handle the demand. Right now, retail barely owns anything. When that changes, the stress becomes acute fast because there's not enough registered physical silver to meet that demand at anywhere near current prices. Now layer in what is happening geopolitically while everyone is distracted by PPI numbers. The U.S. State Department just authorized the departure of non-emergency personnel and family members from Israel. Bomb shelters are being opened across Israel. The official statement advised persons to consider leaving Israel while commercial flights remain available. That specific phrasing, while commercial flights are available, tells you with absolute clarity that they are actively preparing for scenarios where evacuation becomes difficult or impossible. Within 3 hours of a U.S.-Iran situation escalating, $650 billion was added to precious metals market capitalization. Gold gained 1.33%, adding $470 billion. Silver gained 3.82%, adding $190 billion. These are not commodity moves. These are monetary hedges against oil supply disruptions, shipping route closures, and currency depreciation during active military escalation. Physical metal does not care about sanctions. It does not care about blockades. It does not care about frozen accounts. It simply exists. And in a world of escalating counterparty risk, that property becomes priceless. Let me be completely honest about the bearish case, because hype without risk analysis helps nobody, and I will never sell you a one-sided story. The CME demonstrated on Wednesday that they will intervene directly when delivery pressure builds beyond a certain threshold, and they can keep doing exactly that. Shanghai premiums could compress if Chinese industrial demand softens seasonally. Geopolitical situations historically de-escalate more often than they explode into full conflict. Retail could flip from accumulation to liquidation at any moment, and 250 million ounces through ETFs would crater the structure almost instantly. Vaults could get restocked faster than current withdrawal pace suggests. Those are real risks, real possibilities, not hypotheticals to be dismissed. They could slow or reverse this momentum entirely. But now look at what is actually happening versus what would need to happen for that bearish case to materialize. 159 million ounces got cashed out during a 90-minute halt, and those participants did not switch tables. They left the casino entirely. Shanghai Premium sits at $12 while physical buyers queue in the rain, and it is widening through a rally, not narrowing. Vault coverage at 0.60 with drains accelerating simultaneously in Shanghai and COMEX. India formally decouples from LBMA pricing in exactly 33 days. That regulatory decision is already signed and final. 10 consecutive monthly green closes, a historical record as of today's February close. PPI confirmed inflation running hotter than every projection. Retail positioning still minimal compared to every historical silver bull market, meaning the real demand surge has not even begun. Last time silver posted a streak like this, it went from single digits to $50. Last time Shanghai premiums widened this aggressively, Western markets were eventually forced to acknowledge physical reality on physical reality's terms. Last time retail positioning expanded from minimal to significant. 1979 to 1980, silver went parabolic because the market structure simply could not handle the flow. Here is the bottom line. Silver at $92, having just taken out the manipulation high. Price suppression is visibly failing. Shanghai paying $12 over Western paper while physical demand accelerates. Vault coverage at 0.60. 10 straight green monthly closes making history today. India decoupling in 33 days. $650 billion added to metals market cap as geopolitical risk hits State Department evacuation advisory levels. Physical lines forming in Singapore during a rally, not a correction. 159 million ounces cashed out with participants walking away from the casino permanently. Retail positioning still historically minimal. China data from February 27th confirming Eastern premiums holding firm through Western rallies. The data is undeniable when you actually look at it with clear eyes and no agenda. The ones who verified already positioned. The ones who were here already know. This is financial warfare education, not investment advice. Verify every single source I give you. Cross-reference everything. Invest with logic, discipline, and patience. Never with hype, fear, or the noise of people who showed up 3 days late pretending they called it first. You either see the difference or you don't.